I will survive. That is like an existential theme. I don't even know what that means with banks. Does that mean you need more business, or I guess we're going to find out.
It doesn't have to have a meaning. It can just be a great song.
Okay. All right. Cool. Well, Sophia, Agathis, Holland and Knight, delighted to have you here running this panel. We have an esteemed group of providers and users of capital. So take it away. Thanks.
Thank you. Okay. Thanks. Hi, everyone. My name's Sophia Agathis, partner at Holland and Knight in the asset finance practice. This is the commercial bank market for shipping panel, joined today by Martijn van Tool, managing director of maritime finance at First Citizens Bank, Andy Longhurst, managing director of shipping at CSG Investments, Beal Bank USA, Peter Allen, Chief Financial Officer at Genco Shipping and Trading Limited, and Evangelos Katsikiotis, Managing Director at Webster Bank. Before we dive in, if you guys don't mind just giving a quick introduction about yourselves, that'd be great.
Is this on? No. Hello? Hello? Not working? Hello?
Keep going.
Okay. Martijn, Dutch guy. I've been ship finance for 25 years by now, and my latest stint after DVB was with CIT, which became First Citizens Bank, and we're
trading. Martijn, Dutch guy. That's what you missed. There you go.
And in ship finance for not 25 years, for a few banks, and First Citizens Bank, which gobbled up CIT a couple of years ago. So long history in ship finance.
Andy.
Yeah, Andy Longhurst, shipping for 30 odd years, unfortunately. Today I'm with CSG Investments, which is an affiliate of Beal Bank USA, a $16 billion privately owned, regulated financial institution that makes first lien loans against long-term durable assets such as real estate, casinos, hotels, oil and gas, power plants, and of course shipping.
Peter.
Hi, everyone. Peter Allen, CFO of Genco. Genco is a dry bulk pure play company. We own 45 dry bulk assets, Capesize down to Supermax. We like to balance the upside potential of the Capesize sector, the high beta of the sector, together with the relative stability of the minor bulks. From a capital allocation perspective, we have a full revolving structure. We have a low leverage, high dividend payout model. We think that provides really a lot of optionality, and it's a really good risk reward proposition for shareholders.
Hi, everyone. I'm Evangelos Katsikiotis. I'm a lender at Webster Bank, and I'm privileged to run the maritime and commodity finance strategies there.
Thank you. So let's talk about the state of the commercial bank market. One of the things that we've been hearing from some bankers this year is that this is a tough environment. We've heard it's more difficult to source deals now than it has been in years past for a variety of reasons. Some are owners not necessarily needing the cash, Peter. Higher asset values, lack of M&A activity, a ton of alternative financing sources. We heard about the Nordic bond market, Hudson Structure just raised $719 million. So, are you guys facing these challenges, and how are you addressing it? Martijn?
Yeah, it's true. So the banking market is pretty competitive. There's been, for the last 18, 24 months, a bit of a race to the bottom when it comes to margins and covenants. I always joke on the floor, it's a little bit like 2006 again. I hope the analogy stops there. But yeah, there's a lot of money that is coming out of their own corners. Chinese money is finding other ways to do direct deals, not only Chinese related, but elsewhere. Japanese leasing is coming out of Japan, trying to find deals in the West. Greek banks are extremely aggressive, sort of front-running Basel consequences. So it's a very tough deal-making environment. on top of the fact that indeed a lot of owners have pristine balance sheets, don't need a lot of money, or can wait and negotiate firmly. So we started competing with price a few years ago because we could, and now we are reaping the little whirlwind of our own action. So it's a tough environment.
Andy, are you guys facing similar challenges?
Yes and no. I mean, I guess the issue with shipping today is there's a real supply and demand problem, right? Because there's far too much supply of capital and debt and too little demand for it. I mean, people like Peter are using revolvers these days rather than term debt. That's a real problem, and it's pushing margins back down to zero or close to zero, which is, let's be honest, not sustainable for lenders to be lending at that kind of level in this, relatively high risk business. So what we do is we don't really participate in those mainstream commodity deals, and we're happy to sit back and wait for the opportunities that perhaps other lenders are less interested in. And we've seen that last couple of years in, for example, drilling and offshore, which is, we've put money to work in those spaces, and the terms and conditions have been much more attractive for a lender than in the commodity businesses.
Evangelos, are you guys seeing the same thing?
Yeah, I think a lot of investment decisions that we work with our customers are being deferred, partly because of the tariff environment, the question of the port fees. I think that is something that will continue to be the main buy-sell signal for investment, both in 2025 and 2026. So I think both clients and banks there's a lot of capital also on the sidelines waiting to be deployed opportunistically. And I think the resolution of the tariff question in the courts is going to be a major risk on and risk off event. So stay tuned.
Peter, after that, how can the banks, set themselves apart and get a little bit more deal flow in this environment? Is it just, kind of a race to lower interest rates? Is that pretty much it, or?
Well, look, the terms have certainly gotten more competitive over the last few years. At Genco, we've done transactions in 21, 23, 25. The deals that we've done primarily in 23 and 25, they were done because the terms were just that much better. We didn't necessarily have a need to do a refi, but when you have a full RCF structure that's in place that wasn't necessarily on the table in 2021, then that's very attractive, particularly from not only a treasury perspective in managing interest expense, but obviously keeping the same amount of borrowing capacity. With Genco's strategy, we certainly tried to tailor our RCF structure around what we were trying to do from a capital allocation perspective. So we got to the point where we were voluntarily paying down debt. We were reducing our term loan. We were actually hurting the company because we were reducing our borrowing capacity. So when we were able to unlock a 100% revolving credit facility, that played to the deleveraging perspective that we were trying to do, primarily given the strong cash flows at the time and currently, but then also not lose the borrowing capacity to go out and make accretive acquisitions when the time comes. But banks can differentiate themselves. Obviously, terms, speed of execution are huge for us, given this dynamic market, but also just in the relationships. Genco's been around for 20 years. The last 4 or 5 years have been terrific, but the prior 10 to 15 weren't so terrific. So they've been with us from beginning to current, and that relationship and the development of those relationships over time have been very impactful for us.
Martijn, you mentioned 2006, feeling like 2006. What do you think it's going to take to get the market active again? Is it going to be something similar to what we saw back then, or what are you looking for, and what are the indicators?
Getting rid of uncertainty will definitely help. It's not something we control. So the name of the game is waiting and be ready. But we all want to do business in the meantime. So it's finding other ways to compete. We're in the nice position that we are a $200 billion long deposit bank. So we have our own funding. We can compete on pricing, and most importantly, flexibility. I mean, Peter has an RCF on a fleet. We do it on a per vessel basis. Why? Because we can, and not a lot of competition can copy that. So that's how just a simple way to sort of create a little distance between us and the next bank, and the other stuff is just very basic. You have to give certainty of execution. Peter's very right on that. You have to be quick. I mean, imagine you go for your own home equity loan. You want a bank to respond because this is a decision making you have to do. So be close, be quick, be very transparent, and try to be a little different. Find your own competitive edge. That's how we try to roll forward.
So we're going to pivot a little bit. So our hosts have said that the bank market is, quote, the foundation of every solid balance sheet. I guess, do you guys really view it that way, that it's the cornerstone of a strong shipping balance sheet? Or is it just, a necessity for shipping companies because of the capital intensive nature of the business and the market? And when you guys are executing deals, is there an optimal amount of leverage that a company should have? Andy, I'll give that one to you first.
I guess the optimum is that, when the markets are weak, lever up. When the markets are strong, de-lever. Other than that, I don't think there's necessarily a magic formula. What I would say is that the current pricing environment will ultimately force a lot of people that are currently active to be inactive. I mean, I don't know that private equity makes much money as a direct lender when margins start with 100. So I think maybe those guys will pull back a bit. The Norwegian bond market, I've talked about this many times, is anything can get done in that market right now, but it comes and goes. I hope it goes sooner rather than later. Chinese leasing has got its problems. It's fallen foul of the Trump administration. So I don't know, those guys are dropping their rates to maintain market share. Do banks do that? I mean, obviously banks do that as well, but I think bank funding is the cornerstone of a ship owner's balance sheet. I think, we've proven that we've been there through the cycles, and that'll continue.
Evangelos, how do you guys look at leverage for your clients?
Yeah, I think as a general comment, as long as your return on equity is greater than your cost of funding, you've got positive leverage, and if not, you have the wrong capital structure.
Martijn, do you guys look at group leverage? You mentioned that you guys do, single vessel assets, not necessarily across an entire fleet. I mean, how do you guys, take that into consideration when you're doing your deals?
Yeah, the optimum leverage is a function of many things, right? It's a ship owner's risk appetite for one, availability. Sometimes there's shortage of equity, and to do a good deal, you just need more leverage. It's a function of age of the fleet. It's a function of fixed employment or not. So a lot goes in there. Owners will, and the previous panel alluded to it. How long can I stay afloat? How much can I extract from my fleet when the market goes down? So yes, delevering. We have Scorpio as a client. They've always been masters in delevering when the bank market is there, and when the going gets tough, lever up. That's when you go to China, you pay for it, but you have the liquidity. So leverage as a function of the cycle is yet another variable that goes into what is optimal leverage and what isn't.
Peter, you mentioned your $600 million revolver for growth, right? Is this is the perfect amount of leverage for you guys? How do you view it, and how does it vary depending on where the market is?
Yeah, I think that's it. It does vary depending on where you are on the cycle. 50% leverage, which a lot of people have put out as a number, that's this magic number, 50% leverage. But 50% leverage at the fourth quartile of values versus the first quartile is extremely different. Obviously, if you're that highly levered and the market goes against you, you have a problem immediately, and it can go south pretty quickly, as we've seen over the cycles. So we like the low leverage model. It gives you a lot of optionality to go in when you see an opportunity. You can tap the revolver like we've done over the last few years. and it gives you the ability to accretively grow, maybe counter-cyclically at times. The challenge when we look over the last 10 years, there's been really clear investment periods in 2017, 2020 with COVID. The companies that were over-levered at that point in time weren't able to act on those opportunities. They weren't able to essentially get the best investment at the point in time. And if you have this optimal leverage that is high at that point in the cycle, it could actually lead to very suboptimal decision making when the market goes against you. So having the flexibility of the low leverage, but the borrowing capacity, that's really what we look at, is having the borrowing capacity, having the liquidity to go out and make those opportunities and make those investments when they come through.
One of the things you guys have mentioned is the replacement of your term loans with revolvers. How are that impacting your portfolios right now?
Yeah, because we want to compete and set ourselves apart a little bit, we offer term loans with a lot of optionality, flexibility. So our clients can prepay whenever they want, and they can even redraw back to that term loan stepping down. That also means that clients use it, for instance, to have post-delivery financing on new buildings committed well in advance. You have a period where you don't draw, and you come to delivery, you can draw. Hey, and we even say, listen, if you find a much better financing close to delivery, hey, then you don't draw. I won't give you back your upfront fee, and of course you pay commitment fees, but that's all. So that kind of flexibility, that means though that you do quite a few deals where you have commitment fee, but not necessarily full interest. So you miss absolute dollars, which is a pity, but it can make your client, when they need money, they come to you. So you don't have to compete anymore at that point in time. So it is something that leaves a little bit of a hole in your balance sheet in terms of what is drawn, but that will catch up, I'm sure.
But I imagine it's better than doing absolutely nothing for the bank. So, Andy, same thing, or?
Yeah, look, I think from a ship owner's perspective, revolving credit facility is excellent. From a lender's perspective, not so much, right? You don't get paid for the risk. And maybe the company's got the flexibility to use that revolver when you would rather they didn't. So we'll stick with term loans. Makes sense for us. We're on risk day one, getting paid interest on the full amount of the loan throughout the term. There's a lot of capital around today. There won't be in the future. This is still a cyclical market, and I think the markets will go down again eventually. And maybe we'll have a bit of a U-turn, and the revolvers will, go away again for a little while.
Yeah, Evangelos.
Yeah, I was wrestling with this question before we got on the panel, and I had two explanations for this trend, of moving to revolvers. One, probably, if banks want to do some balance sheet optimization, if they're getting, based on their funding profile, better capital treatment for revolvers, that's a potential explanation. But more likely, it's because borrowers don't need the capital right away, and they are kind of setting themselves up to be acquisitive with an opportunistic play in the near future. So, like he had mentioned, it's not, from the bank's perspective, it may not be the most optimal because you're incurring capital costs if the line isn't being used. So if you are planning this strategy, please use your line. But I think, again, we'll return to this with our forward outlook. I think the tariff question is really front and center there because, if the Las Vegas betting odds right now are saying that 76% of the Supreme Court is going to overturn the April Liberation Day tariffs. And if that happens, that's a serious risk-on event where the people who have kind of set themselves up with these lines will be in a very good position. On the flip side, if you haven't, then it's a missed opportunity. But I think it's a balance because I can see the value from the borrower's perspective, from the bank's perspective. If those funds aren't utilized, then it's a drag on the balance sheet, and the risk officer, people will come knocking on your door telling you we need to close this line.
So, we've talked about the state of the market for really traditional blue water shipping. Andy, you mentioned, you guys have looked at other opportunities in offshore. What other types of trends are you thinking might be the right opportunity? What about, the secondary market, for instance? We haven't really seen a lot of banks exit shipping, this year. We've seen a couple big portfolio sales in the years past. Is the secondary market kind of something you view as an opportunity or not really for shipping right now?
Yes, I mean, so we originate loans from $50 million up to $1 billion, which kind of sets us apart and provides our own access to the market. But we do also actively lend into primary syndications, but also lend into secondary market purchases of loans and securities. When the time is right, if there aren't, the right amount of originations available to look at, the secondary market, if the yields are there, is a definite good source of funding and deal flow for us.
Martijn, what about for First Citizens?
Yeah, we're a little bit agnostic to who originated the deal. We have our own capabilities, and I have to say we're all deal junkies, so we love sitting with a client and doing a deal. But we always say if there's another bank that needs us to pitch in, fine, we're happy doing that way. Shipping books that come up for sale, performing, we'll look at those, although they tend to be quite expensive these days. So yeah, it's whatever fits in our wheelhouse. Straightforward shipping, dry bulk container, tanker, that will do. We're not gonna stray from that focus and go into other asset classes because we need to do a deal. Then patience is a virtue. Not do a deal. Sometimes the best deals are the ones you don't do. I mean, remember that.
All right, we have a couple minutes left. So I guess, last thoughts. Where do you think the market's headed next year? Where are the opportunities? How would you kind of characterize looking back and looking ahead? Evangelos, if you want to start us off.
Sure. Like I said, my own personal view is that the tariff regime will get overturned. And I think that's a serious risk-on event for acquisitions and new builds. Of course, I don't have a crystal ball. Anything can happen. I think the Section 232 tariffs will end up staying, and for national security reasons. And I think that it's a positive development for shipping. There's been a lot of encouraging investments made in Jones Act with Hanwha and with Davy, and that's an area that we play a lot in with Jones Act and U.S. flag. And, we're very encouraged with those investments, and I hope that will continue. We're eagerly awaiting the passage of the Ships for America Act in Congress, so hopefully Congress will vote on that soon, now that they're back at work. Look, if for some reason tariffs don't get overturned, I think that's a serious risk of revaluation of assets in 2026. And again, the people who have kind of set themselves up this year with lines of credit to take advantage of opportunistic buying opportunities, I think those people was best placed for success.
Peter, I mean, is Genco done? You got your revolver, you're going to look for opportunities, or, where do you think you guys are headed for the next 12 to 24 months?
We did do a revolver earlier this year, obviously, so we're good on that side of things. But, when we just look at the debt markets overall, obviously the high yield bond market has been red hot. I think it's probably going to cool off for the balance of this year and probably reopen early next year. But I do think that leads to, given all the activity, particularly in the high yield bond market over the last couple of years, that leads to a really good opportunity for the banks. Maybe it's not next year, but a couple of years down the road when all of these refis or these bonds need to roll or be redone. I think the banks can really step in just because it's an up and down market. It opens, it closes. This window has been longer than usual, but I do think banks have an opportunity longer term there.
Andy?
Yeah, look, I've been calling the bottom of the container market for 2 years now, and I will be right eventually. But we do need, I think, to remember that it's a cyclical business. Rates and values will come back down, and we're happy to wait for that event to occur before we put money to work in the commodity spaces, and we'll be patient.
Martijn?
Yeah, just just to mimic that. I mean, there's definitely in the main sectors there's more downside than there's upside. So we're quite vigilant to see timing. You'll never time it, but what can be the catalyst of sort of air coming out of those markets? Is it gonna be a little bit less consumer spending in this country because people, this country talks about affordability. Is that really a thing? Is it gonna bite? Are the containers gonna come off a little bit? Do we see a cascade in? Hey, maybe it's not that rosy. Sentiment is a strange and very powerful thing. So we're just being vigilant. I hope for all my clients that this goes on forever, but we all know that is not the case. We'll keep transacting.
And you'll be there when it doesn't.
We'll keep transacting no matter what the market is. But yeah, we're cautious. We're cautious. Yeah.
Well, thank you so much, guys.
Thank you.